Good afternoon. Welcome to Monday. Welcome to Monday Minutes. Let's cut right to the chase. The inflationary dynamics still front and center. We look over the weekend, the CPI print clearly spilling over into the airwaves over the weekend, dominating the conversation. The Fed is going to watch inflationary expectations. I mean, we've talked about this throughout the course of 2021. They come in all different shapes and sizes. But if you look at market-based, you look at survey-based, and granted, with some of the market-based dynamics, there have been some liquidity issues, but the inflationary expectations indices across the board have all been pointing higher. Now, the Fed looks at the common index of inflation expectations, which we've written about throughout the course of 2021. Former New York Fed President Dudley this morning saying he doesn't know whether or not there's any merit in looking at that index because it tends to move in direction, but it moves very slowly, and it also doesn't stray too far from the Fed's 2% mandate. But anyway, close eye on inflation expectations here. With regard to liquidity issues in the Treasury market, 5 basis point tail last week. Clearly, we saw this in Q1 with the 7-year auction, change in Fed expectations, probabilities, positions. We saw this again 2020 to start the pandemic in March. The Fed came in with this massive quantitative easing program. In some way, shape, or form, this market is still saying that it needs the Fed's involvement. So despite the fact that we have these inflationary pressures, there is talk about the Fed. They could potentially speed up the process of taper. There's no question they are watching these dynamics now on a short-term basis, which lends itself to a very unlikely scenario short-term that the Fed is going to try and rock the boat with a faster taper, which would clearly pull forward the rate increases, which are already creeping in with a timeline, currently a linear timeline out to June of 2022. With regard to the 2022 timeline, the dot plot creeping in, creeping out, depending on, central banks turn hawkish, global central banks, the Fed pushes back, the BOE pushes back. You look at 5-year part of the curve, we get out to 125, 127, and we whipsaw back into 105 to 107. Now with the inflationary data in the marketplace, the tone changes, we get whipsawed back the other way, we're out toward 125. So the bigger disparity to us is really on the longer end of the curve. You look at the forward OIS, you look at the probabilities out there, it's saying, look, the Fed's going to tighten, but they're not going to be able to tighten all that much. So where the market's pricing in the peak cycle and where the Fed's neutral rate is, that curve disparity is pretty dramatic. So we have favored with real yields in and around 10-year real yields getting in and around cycle lows, negative 120. We look at nominal yields in around 140, 142. We look at a range for all intents and purposes in 10 years of 125, 175 for 2022, 21. We think it makes more sense for the market to spend time in the upper quadrant, call it 150 to 175, than it does for the market to spend time in the 125 to 150 range. So we view this price action here as somewhat reasonable. The curve steepening out a little bit. 10-year yields repricing about 15 to 20 basis points off the lows that we saw last week. And finally, with regard to the Fed chair and the nomination there, we're still waiting. The confirmation process is clearly relevant. We've got articles out of the Wall Street Journal. We've got Yellen making comments over the weekend. Look, the reality is, and we've been saying to clients, we don't see all that much of a difference between a Chair Powell and Fed Governor Brainard, depending on who it will be and who the president picks in terms of monetary policy. They're both very involved in reworking the Fed's framework, both very involved in the 13.3 programs, very involved in the quantitative easing programs, holding that longer. And with regard to potential dovishness around broad-based and inclusive on the diversity side for labor, look, the chairman himself has been very, very cognizant and very, very vocal about the damage that's been done throughout this pandemic, and in particular at the lower income level. So in the end, like I said, from a monetary perspective, we don't really see much of a difference, although market perception may lean otherwise. On the ground this week, we've got retail sales tomorrow. We expect a good number. We've got housing numbers later in the week, and then all eyes on the 20-year auction midweek, especially in light of last week's 5 basis point tail in the 30-year. I'm Greg Faranello, head of U.S. rates for Amerivet Securities, wishing everyone a great and successful week.